Market Catalyst. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, stocks are dropping as wholesale inflation data comes in hot. What does this do to rate cut expectations? We will discuss. Plus, CoreWeave earnings leave Wall Street wanting more. CoreWeave's CEO will join us to tell investors why he thinks they should stay in after a blistering 200% rally before that latest pullback. And Deere trimming its forecast as the company warns on the state of farm spending. Is this an opportunity for investors to harvest some profits and walk away? We'll get one analyst's perspective. That's all coming up on Market Catalysts. Let's get a check of the markets here first because we are seeing a modest pullback in the major averages. Right now, in fact, the NASDAQ is little changed. We've got the S&P 500 off by about 0.1% and the Dow down by 125 points. That's about 0.25%. The reaction that we are seeing play out today to that wholesale inflation data that came in much higher than had been anticipated as investors now try to game out what this could mean for the Federal Reserve and rate cuts. And we're also seeing that, of course, play out in the bond market. So let's take a look there at yields, which we're seeing bump up a little bit. Modest moves as well here, 3 basis points or so across the board with the 10-year at 4.27%. Let's get to the specifics now. July's producer price index came in at 3.3% over a year earlier, much hotter than the 2.5% that Wall Street was expecting. That's likely to factor into the market's calculus for an interest rate cut next month. Joining me, Stephanie Roth, Wolfe Research chief economist, and Chris Watling, Longview Economics global economist and chief market strategist. Thanks to you both for being here. Chris, I'm going to start with you because, the market sort of seemed reassured by the consumer inflation data we got. Then you get this wholesale inflation data. How surprised were you and what is this telling us?
Well, I mean, it was a bit of a move. It was quite a big surprise to the upside, I think, if one's honest. But frankly, I don't worry too much about what producer price inflation tells me. And I mean, very rarely does it cause major upsets in markets. I think the market's much more focused on CPI and what we get from the Fed as a result. But clearly, this sort of bump up in PPI means there's a bit of margin squeeze. And I think it's probably telling you that companies are absorbing a little bit of those tariffs, and therefore PPI is going up a little bit faster than CPI. And of course, PPI is your input prices, CPI is your output prices if you're a business. So I think of it like that. It's a minor negative. The market's digesting it. It's off a little bit, as you said. Bond yields up a bit, gold off a bit. It's all the sort of classic responses to a little bit more back up in yields and a bit more price inflation than one would expect. But as I said, I wouldn't worry too much about it. I think it's a short-term thing, and really it's the CPI that matters the most.
Stephanie, what do you think?
I'm a little bit more concerned about its impact on future CPI prints. I think it's telling you that the price effects are starting to work its way throughout the supply chain. And companies are going to probably try to pass it through, in which case I think we're going to see hotter inflation prints in the next couple months. And yeah, maybe the July CPI print wasn't that strong, but come August, September, we might start to see firmer prints, and that puts the Fed in a tough spot.
Yeah, Chris, I want to sort of dig more into this discussion with both of you because we're talking about a cadence issue here, right? This is something the Fed has said over and over again, that they're sort of waiting to see how the tariffs make their way through the economy. And if we're seeing PPI at this level now, Chris, won't you then see it in PPI as we head as we head towards the fall?
Well, there's a lot of things going on in CPI, and there's a lot of factors that influence CPI. And one of the most important ones is really how strong the economy is. And I think that the data's been building in the last few months that show the economy is slowing. And it seems to me getting clearer and clearer. And we're getting these calls for 50 basis points from members of the sort of finance community, even the Treasury Secretary. So, I think that's a more important factor. CPI is a lagging factor. Maybe a bit of PPI shows up in this, but frankly, we've been talking about this for 3 or 4 months now, and the evidence isn't very clear. It's in bits and pieces of CPI, but it's not affecting CPI in the round. So I think the more important factor here is the employment and the growth mandate, if you like, which is a sort of subset of the employment mandate of the Fed, rather than the inflation mandate, which, as I say, is lagging. So I think that's where the focus should be, and I think that's where the market's focus is shifting as it's priced in these cuts in the last few days in the curve out to the end of the year, priced in more cuts.
So Stephanie, is the labor side of the equation going to be continuing to show weakness and supportive of a cut?
Yeah, I think that's where my view differs a bit. So yes, there were some significant downward revisions to June, and then mathematically that may get revised down to some extent. Looking ahead, you're starting to see signs that the data are bottoming. And if you think back to what happened from May to June, you had significant tariff uncertainty. You had 500,000 people lose their work authorization from some of the immigration policy. That's kind of in the past, and now you're starting to see things bottom out. Sentiment is stabilizing. Job postings from Indeed are starting to pick up. So this might have actually just been a one-time shock to the economy, and we might start to see a labor market that's a bit better. Now, payrolls are likely to still be fairly muted, something like 60 to 70,000 per month, but not something that's that onerous, something that's decelerating at least into the future.
Okay, so Stephanie, put all that together for us then. Do you think that September rate cut is happening?
I think it has a lower odds than what's priced into market. So I don't think it's in the 90% range, which is currently in the pricing. I think it's much more of a debate than that. Realistically, the odds are shaping up that it's more likely than not. But I think what's more concerning or confusing is to what extent they're going to be more rate cuts after that. It's possible the Fed will cut in September, and then the inflation data will make it a lot more difficult from there.
Yeah, and Chris, what do you think? Do you think the market is overpricing the odds of that cut?
Well, I mean, yesterday's close, I think it was high 90%, so it's hard to overprice
still,
it.
Even after the wholesale numbers this morning, it's still around there.
Well, I mean, I think they should definitely cut. I think the question is whether they should cut more. I look at ISM services, it's basically at 50. The manufacturing sector's had no growth in 3 years. Housing's deteriorating. I think it's a really clear slowdown in this economy, and I'm amazed the Fed isn't getting on with it. The rest of the world's central banks are way further on in their rate cutting cycle. So yeah, I think they should cut in September, and I think the market's right to price it. And it's pricing one in October as well, and December, good chance.
Chris, let me push back on all of this a little bit. We had Howard Lutnick, the Commerce Secretary, in an interview saying he expects the tariff revenue coming into the U.S. per month to go up to something like $50 billion from where it was, which was $30 billion, which was already a huge increase last month. Doesn't that imply that still a lot of the tariffs have yet to be felt? I mean, I was telling Stephanie in the makeup room, this is anecdata to be sure, but I was having a chat with a friend of mine who works in the home decor and furnishings business, and she said, where we're going to see the price increases is holiday because of the forward order cycle that retailers operate on. So doesn't that imply that the Fed is going to be in a really tight spot if things are slowing as much as you suggest, and if that price increase is coming?
Well, I mean, in a sense, it's in a tight spot. But my point is, the more prices go up, the more tariffs get into CPI, the more you got a fiscal tightening, the more you're draining people's pockets and they're buying less goods. And so actually, it's a negative either way. Either CPI goes up. Or CPI goes up, it's not really the inflation dynamic you want to think about. It's the fiscal tightening, which is effectively what it is. I mean, I would say if we did this in the UK and we put up a VAT rate, our equivalent, you'd call it a fiscal tightening. And I think that's exactly what it is. So that to me adds to the slowing dynamic in the US economy. It doesn't, the Fed shouldn't be looking at that. You should look through that. That's one off, and then they should look at what's really going on in terms of the underlying growth in the economy, which is slowing and which will slow more if more of that tariff effects feeds into the CPI. So that's the way I think about it. I think this is economy under a lot of pressure.
And then Stephanie, I guess I would push back on you a little bit as well to say, well, if tariffs are still making their way through the economy, won't that also have a slowing effect? Won't you have businesses who are having to pay it who maybe aren't hiring as much, for example?
Yeah, and we've already seen that growth is now trending at 1.5%. We've had a material slowdown this year, and we do think that growth will end up being still around 1.5% through the back part of the year. The thing that markets seem to be looking through and looking for into next year is we might start to see an inflection, because then we get some positive fiscal stimulus from the bill, which will start to have its effect in the back half of this year and into next year. So yeah, we are facing the effects right now of tariffs, but that doesn't mean it's going to certainly tip the economy into recession. That's not our base case by any means. And then we might actually start to see things bottom out as uncertainty starts to fade, and then fiscal stimulus starts to give a positive impulse to the economy.
All right, well, we'll see how it all plays out. Thanks, guys. Really interesting stuff. Stephanie, Chris, take care.
Thank you.
Coming up, we'll be joined by CoreWeave CEO Michael Intrator. We'll talk the company's growth outlook, AI demand, and much more. That's coming up on Market Catalysts. CoreWeave shares extending declines after widening losses sparked fears around the company's growth outlook. Joining me now is Michael Intrator, CoreWeave CEO. All of that said, your revenue last quarter, Michael, grew by more than 200%, and the stock is up about 200% over the past year as well. But so given that, and given the sell-off that we now see stretch into a second day, I'm just curious what message you would have for investors and for the bears, perhaps, who are sending the stock lower.
So first of all, thank you for having me. I appreciate the opportunity to address your audience. I couldn't be prouder of what the company has accomplished this quarter. We have, we beat expectations by a significant amount, over 12% this quarter. We raised our guidance for 2025 by 5%. Remember, we're already more than halfway through the year, and we're still raising a full 5% for 2025. The company is hitting on all cylinders, and it has been an incredible exercise in execution at our company to continue to build and deliver the infrastructure that the world requires in order to drive artificial intelligence. And it's always strange for a CEO to get on and kind of talk so positively about what's going on at the company when the stock has clearly gone through such a significant pullback. And in my mind, the pullback is entirely caused by the lockup release that occurs at 4 p.m. today and will be done. And so the performance of the company, there was $1.2 billion in revenue generated in Q2, of which there was $200 million in net operating income. So the fundamental building blocks of the business are incredibly strong. It really was a blowout quarter for us. Stock's going to do what it's going to do in the short run. Lockup comes off. It's a moment in time. And then we fully expect, or at least I fully expect, that the company will revert to reflection of the fundamentals of our business, which are, in fact, extraordinary in an industry that is growing at an unprecedented rate.
Michael, first of all, I have to give you credit. A lot of executives will come on with me and I'll ask about the stock and they'll say, oh, I'm not paying any attention. So kudos to you for at least acknowledging the reality here. I want to linger on the lockup for just a minute because I'm curious what you expect in terms of insider selling. And I'm curious if you yourself intend to take some profits after the run-up that we've seen in the shares.
Sure. So look, when a lockup comes off, it's an opportunity for people who have invested and supported this company from when it was in when it was in the single digits of millions of dollars. And they have been supporting us and helping us build this company and giving us access to their capital. So certainly some of these early investors, many of them are individuals, not even funds, are going to take some off the table. It's appropriate. It's the right thing to do. And so we fully expect that to happen. However, having said that, we think it is a relatively small number of sellers that we're going to come through and sell blocks of stock. We think that it is going to be a non-event. We think it's going to clear through very quickly. The supporters of this company are investors who understand the position of this company and the role that it's going to play over the next 10 years. And so, yes, I do pay attention to the stock. My employees do pay attention to the stock, but I do think that the employees and the shareholders that have supported this company up to this point really are focused on where is this company going to be in 6 months, in 9 months, in 5 years. And when you look at it through that lens, the stock is going to do what it's going to do. I come from a Wall Street background. I understand the trading of it. I understand that people are shorting into the expectation that they'll be able to cover their short with these new shares that come to market as the lockup releases. And I expect that there'll be less than people expect, and then it will move back towards value for the execution that we've been doing.
So, Mike, let's talk about then sort of the backdrop beyond what we're seeing in the shares, because it seemed like there was some concern being expressed as well about the spending that the company is doing to grow. Obviously, you're seeing growth as well. How should we be thinking about that spending cycle, sort of how long it lasts at this kind of volume?
So our company is relied upon by the largest, most important consumers of compute in the world. It is the leading AI labs. It is the hyperscale clouds. It is the tech-forward enterprise clients. The folks that really require computing power to move their business forward. It's the people who are building the future, and the companies that are building the future. And it's a privilege to be able to be one of a relatively small number of companies that are able to build infrastructure at this scale and of this quality that allows the artificial intelligence that will drive the world for the next 50 years to be built on our infrastructure. We're really excited about that position. We will continue to invest in that. We will continue to build for those clients that require it. And we will continue to scale the company and provide the large and expensive infrastructure that's required. It's a great business. The margins are great. We're able to really kind of move our company forward. We have chosen to use a model that relies upon more debt because we are a smaller company competing against very, very large companies, and we have accessed pools of capital that up to this point have never really been able to come to bear on the build out of technical infrastructure. They are in fact the backbone of building out every other type of infrastructure on the planet. If you buy and build power plants, these are the people you talk to. If you build airports, these are the people you talk to. And we believe that we have structured it correctly so that you can use those tools to build the computing infrastructure of the planet.
Mike, as you said, you work with the largest companies that are doing this, that are relying on your compute capacity. Some of your critics have also said perhaps you're over-indexed to a few large clients. What happens if those large clients say, well, we're going to bring all of our compute in-house, for example? Sort of what's the diversification strategy going forward?
So in the earnings call, I tried to really speak to this in a couple of different ways, right? First of all, it is the nature of this business that there are going to be large players that require large blocks of compute. There aren't going to be 300 foundation models. OpenAI and a few other important labs are going to build the foundation models that the world uses. And so it's a incredible privilege for us to be able to serve compute to the foundation model builders and the large clouds that are going to consume this compute at gargantuan scale. At the same time, we have brought on new clients every single month since we founded this company. Recently, we acquired a company called Weights and Bias, which extends our software offering. And that brought in an entire new tranche of clients like British Telecom. We have clients within the visual effects space like Moon Valley. We have clients in the healthcare space like Hippocratic AI. Like there are so many new clients that are joining and diversifying our revenue. There are so many new clients that are becoming dependent upon the infrastructure and the quality of the infrastructure that we provide. You know, we're going to have large clients. We're excited about those large clients. It makes it so that the contracts can be underwritten by the large lending institutions. It's really exciting to see that happen, but it's also exciting to see new clients come on and use our infrastructure as successfully as they have.
And Mike, finally, I want to ask you about Core Scientific. That's the big deal you guys are doing to get more ownership of the compute, the data center capacity. I'm just curious about how you think the chances are that it's going to get regulatory approval, if you see any risk to that.
Yeah, I don't see really any risk to the regulatory approval component of it. There are a lot of data center providers within the U.S. Core Scientific represents a data center provider. We have relationships with many of them. I think the regulatory component of this transaction is relatively straightforward. And I believe that we'll probably get a significant amount of support as we go through that. You always got to go through this stuff. You got to work through the system. You've got to present your case correctly. But I'm confident that from a regulatory perspective, we will not face any material challenges as we look to integrate the companies.
Mike, thank you so much for spending some time with us this morning. We really appreciate it.
Thank you very much. Appreciate it.
Take care.
Talk to you soon.
Coming up, what do Apple, Klarna, and JD.com have in common? They're all trending on Yahoo Finance today. We'll give you the news behind those moves next on Market Catalysts.
Welcome back to Yahoo Finance. I'm Allie Canal, live at the NASDAQ, and let's get a quick check on the market action about 1 hour into the trading day. We're still seeing losses across the screen here after that PPI print came in hotter than expected. So these are the prices that producers are paying. So we're seeing businesses bear the brunt of the tariff hikes, and that's yet to trickle through fully into the U.S. consumer, but that's been a big concern, also leading to a slight recalibration of rate cut expectations, but not much. Market's still pretty much pricing in with 100% certainty that the Fed will cut rates in September. So across the screen, you're seeing that we're well off of this session lows. The Dow is only down around 80 points. The NASDAQ trading essentially flat, and same with the S&P, down roughly 0.1%. Now, I will say that if we take a look at long-term yields, like the 10-year yield, we are slightly higher. Again, not much, just up around 3 basis points, still well below 4.3%. And same with the 30-year yield, well below 4.9%. Now, I also want to check on some trending tickers because we're seeing Bullish, which just made its IPO on the New York Stock Exchange yesterday. That is up around 22% today. Now, that follows an 80% plus rally that we saw on the heels of that IPO. Now, remember, Bullish operates a crypto exchange. It also owns the trade publication CoinDesk. It was priced at $37 a share. We're now seeing shares trade around $83 a share. And this comes really as there's been a lot of enthusiasm over the crypto story at large. If we take a look at where Bitcoin prices are, since we are a bit risk off in the markets right now, we're seeing that hit all of the cryptocurrencies. Bitcoin is down around 2.5%, Ethereum down 0.6%, and Bitcoin prices, they have been on a significant upswing. We did hit a record high early this morning, but over the past month, we've really been struggling to surpass this $120,000 level. So that is a key technical level to watch. If we can get above that and really sustain that, we could maybe be poised for another Bitcoin leg higher. And then same with Ethereum on a month-over-month basis. We are up over 50%. And this comes on the heels of greater regulatory promises from the administration. There's a push into 401ks. And not only are we seeing this retail enthusiasm, it's also happening on the institution side. So across the board, anything that touches crypto seems to be doing very well in the recent trading action. But today specifically, risk-off environment is leading to some losses there. But keep it right here on Yahoo Finance. We'll be tracking all of the market moves throughout the trading session.
Now time for some of today's trending tickers. We are watching Apple, Klarna, and JD.com. First up, Apple getting a win in its years-long legal battle over its blood oxygen tracker. The feature was removed at the end of 2023 due to a patent infringement lawsuit by Masimo and a U.S. Customs injunction. But a new ruling will allow the existing watches with the feature to display those blood oxygen levels on the iPhone, but not on the Apple Watch itself. Apple's announcement states that U.S. Customs has ruled that the company will be able to import watches with this redesigned feature. Next up, Klarna, the buy now, pay later company, reporting that it set aside more money for potentially souring loans in the second quarter. That led it to disclose a $53 million net loss for the quarter, which compares to an $18 million loss in the same period a year earlier. It put aside those higher reserves to cover potential credit losses. The company also reporting it reached 111 million active consumers in the second quarter. Remember, Klarna is still a privately held company, and it has pushed back its initial public offering several times, reportedly may be considering it once again for the fall. And finally, China e-commerce giant JD.com out with earnings results, posting revenue that topped estimates, but a costly push into new arenas such as meal delivery eating into the company's profits. JD ignited a three-way battle in e-commerce this year after hiring delivery personnel and launching promotions to break into the meal delivery and fast commerce markets. But pricing battles with competitors have begun to compress its profitability. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Coming up, checking in on shares of Bullish after their blockbuster IPO. We'll hear more from an analyst about what the crypto exchange's debut means for the IPO market. Let's check in on shares of crypto exchange Bullish. The company rose more than 80% in its trading debut Wednesday. It's the latest sign of IPO enthusiasm in the market after several challenged years. The Peter Thiel-backed company also owns crypto news site CoinDesk. Its IPO has drawn investment interest from BlackRock and Cathie Wood's ARK Investment Management. Market Domination host Josh Lipton spoke with Ed Engel, Compass Point Research and Trading senior analyst, about the company's debut and the broader market opportunity for crypto exchanges.
Bullish is an international crypto exchange. So similar to Coinbase, they offer buying and sellings of different digital assets. They also operate and own some media assets such as CoinDesk and also provide information services. And I think the big difference there is these guys mostly focus on markets outside the US. And I think one of the big opportunities for them is to maybe get into the US where competition is a little bit less intense domestically than it is in some of these international markets.
And it sounds, Ed, like their focus is also, listen, they're very focused on serving institutions, Ed. How excited, generally, would you say, enthusiastic or institutions about this space? I mean, we know retail investors, plenty excited, but how would you gauge the excitement of institutions?
Yeah, I mean, we could even argue that retail penetration in the US is actually decently high, where during last bull market, millions of people signed up for either Coinbase accounts or Kraken accounts, where that actually got penetrated fairly quickly. On the institutional side, we can probably argue that there's a lot more runway for growth, just given that historically institutions did not have access to these crypto exchanges. And so that probably does differentiate a Bullish a little bit more from a Coinbase, where Coinbase historically does kind of focus more on that retail user, while Bullish is a bit more on that institutional, whether it's a market maker or algorithmic trader.
So Ed, for investors listening, how big is the ultimate opportunity here for a company like Bullish? Can we try and put some numbers on it, quantify it?
Yeah, I mean, again, in the institutional market, also the pricing is going to be much, much lower. So the take rate that these exchanges earn on institutional trade is going to be fractions of what they are in retail. And then alternatively, on the international markets, these are much, much more competitive. You're competing with companies like Binance, OKX, Binance, and what you see is the fee rates in these international markets are razor thin versus what we see in the US. And I think that's one thing that Bullish has done a good job at, is they've still been able to grow while kind of competing on pricing. So it'll be interesting if they can kind of maintain that lowest cost provider aspect within the U.S. Ed, if they can get in the U.S.
This theme, Ed, we see, I mean, more crypto-focused names making their public debuts. I mean, so it's Bullish, it's eToro, it's Circle, it's Galaxy on the NASDAQ. Do you expect more to come, Ed?
Yeah, absolutely. Again, there's a ton of pent-up demand, especially from the equity markets, for these types of companies. So historically, equity investors weren't able to get exposure to crypto companies. And alternatively, it was really just retail traders that could get access to these crypto exchanges. And I think what's different about this cycle is you're just seeing a lot more companies, whether they're newly listed companies like Circle and Bullish, or even these emerging crypto treasury companies, where it just shows you that there's tons of demand from both retail and institutions for these types of companies. In the coming months, I'll add there's going to be a number of companies have publicly are confidentially filed for IPO. So we have Bullish that just came out, but a number of other companies have also confidentially filed, and we're expecting those to kind of come out over the next couple months.
Ed, I have to ask, we were just showing the response to Bullish there. When you see that response, whether it's Bullish or to Circle, Ed, does it seem kind of frothy to you, Ed? Does it seem kind of, I don't know, SPAC-like, or no? These responses we're seeing, they seem reasonable to you.
Yeah, I mean, look, these are, for Bullish and Circle, these are IPOs rather than SPACs. So I think just a lot more, honestly, investor protection on some of these more IPOs, while historically the SPAC boom did get a little bit crazy in terms of probably not the same protections and rules that an IPO would have. But I mean, I think some of your points are valid. We've seen a lot of demand for these crypto treasury stocks, and volumes on those have been extremely high. And if you look at the valuations for a lot of these companies, we're actually a lot we're definitely extended versus where we're historically. And so I think if there is a scenario where some of this does cool down, you can make the case that some of these crypto companies probably do have a bit more of an extended valuation. Is
that why, Ed, we just showed that you got a sell slapped on Circle. You don't have many sells, but that's one of them. Is that why it is a valuation call?
Yeah, I mean, we also have a sell on Coinbase, and I think our view for Circle is, look, this is a terrific company. They've got a great moat within their area of stablecoins, especially in areas like DeFi and crypto exchanges. That being said, the stock's trading at over 80 times next year's EBITDA, which is a wide premium to some of these other crypto companies. And so I think it's a combination of, yes, valuations for that one, and as well as Coinbase does feel a little bit extended here. And then just meanwhile, just as institutions start to embrace digital assets more, I think it's still to be seen how much the incumbent financial companies have a say in this space. So whether it's companies like Stripe or JP Morgan or Bank of America, if these companies start to enter the blockchain industry and offer their own stable coins or crypto trading capabilities, it does kind of make us wonder how much of a moat some of the larger crypto companies today have.
I want to end here, Ed, on some comments. I did hear from execs at Bullish today. They said they were taking the proceeds in stablecoin, Ed, which I thought was interesting. What do you make of that?
Yeah, again, I have not had a chance to talk to management, so I'm a little bit behind on you there. But I mean, I think they have some plans to invest that into Solana ecosystem and maybe help that Solana ecosystem get more liquidity. But I think that's going to be a very nuanced opportunity for them.
John Deere trimming the upper end of its full-year guidance as low grain prices and lagging demand hit farmers' finances. The more cautious forecast coming after a solid fiscal third quarter for the farm machinery manufacturer. Adjusted earnings per share were slightly better than anticipated, although they were 32% lower year over year. Joining me now is Jonathan Secreta, CFRA research analyst, to talk more about these results. So, Jonathan, as we look at these results, what is it telling us about where we are in the farm cycle and the sort of hopes for a bottoming?
Well, it's telling us that the expected recovery might not be as fast and as strong as investors were hoping for. Really, the expectation is that starting early next fiscal year, we're going to see a double-digit earnings recovery, but really that guidance is kind of souring some of those expectations. And I think the biggest factor here is tariffs are quite a wrench in the gears of this cyclical potential recovery. And it's not just affecting bottom line results, but keep in mind, farmers are very wary. They've been dealing with these lower commodity prices for some time now. And even before Trump took office and introduced the current tariff regime, they're already very exhausted, if you will. So I think this could potentially extend the stagnation here further. And we currently have a sell recommendation. So actually a contrarian view that we've been managing, and it seems like this quarter kind of confirms that.
I mean, the shares, they're up like 35% over the past year, Jonathan. So what has been driving that, given that the fundamentals are pretty murky here?
A solid execution. So Deere & Co. has done a very good job of managing their costs, reducing inventory levels. They continue to position themselves to invest for the future, right? This is a best-in-class company. There's no doubt about it. They typically have above-trend margins and leading profitability versus the rest of the industry, and they maintain market share dominance in one of the most attractive markets, being North America. But with that said, we really can't ignore some of the fundamental weakness seen within agricultural markets. Deere & Co. is downstream from commodity prices. They're downstream from the health of the farmer. And looking at that right now, it's not exactly a very rosy picture.
I did talk to the CEO of AGCO after that company's results. And he pointed out that these things do move in cycles, right, in terms of crop prices. And he was relatively, confident that we would see that upturn, perhaps, if not, in the end of this year, going into next year. What do you think on that front?
I think there's some risk to that assumption. That's been the assumption the broader market has had. It's one reason why Deere & Co. has outperformed so strongly year to date. But this cut to guidance isn't exactly aligned with that,
Right.
Especially since it's the fourth quarter of their fiscal year. This is the tail end of it. So the fact that they're becoming more cautious, which should be the beginning of a recovery, is not at all too convincing. And also, Deere & Co. has a very large exposure to some of the larger farm machinery, tractors, harvesters, loaders. And this is particularly where there is weakness. These higher priced, larger capital intensive products that farmers are especially cautious on spending given the broader macro environment. So Deere & Co. is a little more pressed here. Also keep in mind, Deere & Co. has greater exposure to North America where there's some weakness. So in this case, AGCO might have an advantage in being a little bit less concentrated where the weakness is really emanating from.
Well, I'm glad you mentioned the price sensitivity among farmers right now, because another area that Deere and its competitors have really been pushing aggressively into is what they like to call precision agriculture, right? We're talking about, AI assistance for tractors. We're talking about autonomous machinery as well, which is higher cost. So
Right.
Do you think that investment will pay off when the farm cycle turns up again?
Absolutely. I think that this is one of the reasons they've been able to push pricing power a bit beyond their peers, beyond CNH Industrial, beyond AGCO. These investments have been one of the most attractive reasons to invest in Deere over their competitors. And certainly once the farm cycle ramps back up, the story will be different, right? It's a cyclical name. Our only hang up is the timing of the recovery and the intensity of it. We're a bit skeptical, and that does make our view a bit contrarian versus most who are more neutral or optimistic. But once again, long term, this has been a good investment for investors. It's a quality company, and this investment in automation is going to be very attractive once the health of farmers does improve.
Speaking of investments, the company is also making a $20 billion investment in U.S. manufacturing. We've obviously seen a lot of companies doing this recently. It might make sense from a political point of view. For a company like Deere, does it make sense from a strategic point of view?
It does. The market for Deere that's most important to them, where, like as mentioned, the majority of their sales and profits is coming from North America. So it's even more important for Deere to localize their production to meet demand and produce where their demand is. So this is going to take several years. Reshoring, and it's a very exciting topic right now, but this is something that takes several years for the build out to take place for manufacturing footprint. And for it to finally come online, it could take 2, 3, even 4 years for a more advanced factory to start production. So we do think it's a good way to de-risk supply chain, especially for a company like Deere, but it's going to take some time.
And Jonathan, won't it raise their costs, though, to bring that into the U.S.?
It'll raise their costs, but I think that investors, especially after the inflation or the global supply chain crisis that's been dealt with for years now, especially looking to 2021, where it's just supply chains were in complete disarray. Deere & Co. actually had the opposite issue where they had huge demand at the time and they couldn't meet that demand. Shares suffered because of that. So I think that investors, they're willing to see a little bit of short-term pressure on cost related to reshoring if it means that there's less of a shock to supply chains going forward.
Jonathan, good to catch up with you. Appreciate your perspective on this.
Yep, thanks for having me.
Coming up, full market coverage ahead in the second hour of Market Catalyst, including a conversation with the CFO of the world's largest meat processing company. Don't go anywhere. Coming up this hour on Market Catalyst, first up, we'll have full market coverage ahead as hot inflation weighs on stocks. Plus, Tapestry sinks as tariff costs weigh on its profit outlook. We'll break down how the trade war is affecting retailers. And Peloton reportedly planning to release a new bike, accessories, and artificial intelligence products as part of the company's overhaul. We'll have that and much more on Market Catalysts. 90 minutes into the start of U.S. trading, I'm Julie Hyman. Let's get a check of the markets here. Major averages under some pressure today, but the Nasdaq actually peaking up a little bit following the PPI report. We've been talking to some economists and market participants over the past couple of hours. Chris Watling over at Longview Economics said he did not think that this reading would be an obstacle to the Fed cutting rates in September. We've got the Dow right now down about 100 points, about a fifth of 1%. The S&P very slightly lower, and the Nasdaq's in the green. Can AI help you pick stocks in a volatile market? Market Domination host Josh Lipton asked just that in a conversation with Doug Clinton, Intelligent Alpha founder and CEO. His company uses large language models as part of their investment strategy.
What we do is we use 3 of the leading large language models, names that you probably recognize like GPT or Gemini. We use them to go and do stock analysis. So we give the models a certain amount of data that we sort of curate, and we believe will help the models understand what a stock is, what the underlying business actually does, and then whether it's a good investment. The models look at that data just like a human analyst would, and then they create a portfolio that is our final output. A human oversees that last part of the creation to make sure that there's no hallucinations or other AI issues. But that's how our process works. We use AI to basically create these stock portfolios end to end, like our Livermore ETF LIVR.
When you, Doug, think about this Q2 earnings season and you look at that mega AI trade and trend, Doug, how healthy, how resilient, how intact does it look to you?
I think it's still intact, but what we're seeing is a little bit of a changing of the guard. And so if you think about kind of the last 2 or 3 months, so since the market bottomed in May, we just had almost anything that touched AI, anything that was tech felt like it was on a tear. And we had a lot of companies up more than 100% over that 3-month time span. You know, CoreWeave being an example, that one got hit a little bit today. But I think what we're seeing now is everybody kind of rushed into anything AI. And now I think we're starting to see investors pick and choose a little more as we've seen the earnings numbers come through and see which companies really are sort of delivering on their AI promise and which ones, you know, maybe just got caught up in the hype. In terms of our models and the AI trades that our models like right now, obviously we're still fans of NVIDIA, but Micron and Arista are 2 other infrastructure players that our models are still favorable on.
So with NVIDIA, and of course they've got earnings on deck, I mean, listen, you would listen to those big tech earnings calls and you would hear about how they are just dedicated to spending on building out their AI infrastructure. Given that, Doug, you expect to hear what from NVIDIA when they report?
We think it's going to be another strong quarter from NVIDIA. I think that's probably to be expected at this point. So the question is really going to become, you know, what is priced in and sort of what's the whisper, the hurdle they really need to beat. I think at this point, though, the commentary we saw from the mega caps, almost everybody reiterated, you know, there's no slowdown in spend. We heard from CoreWeave earlier today that supply is still a problem. Demand is still very strong. And so I think you're going to hear a pretty good number from NVIDIA. The stock has been on, you know, a pretty good run itself from that May low. I think they'll probably be able to do enough to keep investors excited, and we'll also start to be hearing about some of their next generation chips as we think about what could happen next year for the stock as well.
Doug, when would I get cautious on NVIDIA? Would it be, I mean, do I have to just wait and listen for Nadella or Zuck to tell me, hey, actually, we're going to start cutting big on our AI CapEx?
I think at that point, it probably would end up being a little bit too late. I think what will happen is we'll start to hear real serious rumors and probably real projects being delayed in terms of some of these larger infrastructure buildouts. There's been these sort of small rumors and like reallocations that people have brought up. Microsoft is often in the news associated with this. And those have just been, you know, I think sort of noise for the most part. But I think the real first signal is that at some point, and I still think we're probably at least a year away from this, if not more, we'll start to hear about bigger projects getting pushed back and then maybe bigger projects even being canceled. I think that's your real sign. And then I think you'll hear the mega cap CEOs saying, you know, hey, our CapEx is flat this year, right? Which I think would be a bad thing for NVIDIA.
So those models you discussed, Doug, so they said NVIDIA is one to own. What do they have to say about Apple? I'm curious.
Apple is one that the models have not owned. And in terms of just the Mag 6, I'll just confine it to that. Our models have been a fan of over the last quarter at least, of NVIDIA, Microsoft, Meta, and Alphabet. Those are kind of the four that our models have bet on. We have not been in on Apple or Amazon. And I think there's actually a really interesting distinction between those two, where the four companies that our AI models are fans of at the moment do have very strong AI businesses kind of across the board, where Apple and Amazon both, I think, are a little bit weaker on that AI story. I think Apple, they had this great White House event. The stock got a big bid because there was good news around at least potentially, tariff relief for them. But I think the big question still remains, which is what will they show us in AI? And I think we're still not going to get much on those answers until sometime next year.
I was talking to your buddy, Gene Munster, Doug, about Apple. I'm curious to get your take. And I was talking to Gene, and I'm paraphrasing, but basically Munster's point on Apple was, listen, they have this giant install base. It's billions of devices all around the world. These folks are loyal, they're locked in, and that gives Tim Cook time to figure out this AI story and strategy. They don't have forever, but they got time. They got a long lead time to figure this out. What do you make of Gene's argument there?
Gene and I have many spirited debates, Josh, as you know. I think he's probably right on that point, though. I think the one thing that I would say to Gene's point is, look, if Apple didn't have this incredible user base, very loyal customers, they might look more like an Adobe, which unfortunately our models also have liked, and that stock has just been hammered because I think the story there is, hey, AI might actually be really bad for your underlying business. And I think that's been a theme across many software companies. And so I think to Gene's point, Apple is probably getting some benefit of the doubt that they can come into this race late, as they often do, still show a really great product, and then ultimately maybe pull out some kind of a win in the future.
Coming up next, we're going to check in on the crypto market with a panel of experts. That is next on Market Catalysts. JBS, the world's largest meat processor, reported record revenue in its latest quarter despite a challenged macro backdrop. The company's U.S. beef business, which makes up about a third of its overall sales, was pressured by a severe shortage of cattle in the country. Strength in JBS's subsidiary Pilgrim's Pride, which is a major chicken producer, helped offset the U.S. beef division's nearly $300 million loss. Joining me now, Guilherme Cavalcanti, JBS's Global Chief Financial Officer. Guilherme, good to see you once again.
Good to see you, Julie.
Talk to me about U.S. beef. What is going on with cattle in the U.S. that caused this shortage, and how long do you expect it to last?
Yes, so basically the herd of U.S. in the lowest level in decades, for many reasons. I think we passed through through a good moment in 2020, 21. That was followed by 3 years of droughts. So the cattle rebuild herd took longer than expected, basically because we had, again, droughts in the last years. This year, we have moisture, we have rain and snow, so pasture conditions are good for cattle rebuild. But this, in the short term, already impacts, because in order to rebuild the herd, you have to retain cow. When you retain cow, it's the less cows for slaughter, and then more pressure on the supply of cattle.
How long, we've already seen beef prices go up here in the United States. How long do you expect those prices to be elevated?
Yeah, so on the cattle side, as you mentioned, we still expect, so if we start the cattle rebuild this year, we will have the cycle of the cattle is 2 years. So we will be starting the inflection point in 2027 and seeing results in 2028. During this period, most likely beef prices will continue to be pressured because of the supply of cattle.
Wow, that's a long time to have those higher beef prices. Luckily, you guys have the chicken business as well, and that business has been performing better. And when we last spoke, which was on the day that your listing, your primary listing came to here in the U.S., and this is your first earnings report since then, we should mention, you talked about that balance in the business, right? That diversification in the business. So how much did chicken make up for some of the weakness in beef?
Yeah, so the beef is 30% of our business is the U.S. beef in terms of revenues. The chicken, U.S. chicken, the PPC is around 25% of our global business. So the chicken going on a tailwind offsets great part of the U.S. beef. But also the Brazil beef and the Australia beef is also offsetting the U.S. beef. So again, basically in our platform, basically all business units except the U.S. beef, they are all performing well, helping to offset what 1/3 of our business is in this challenging period.
Since we last spoke, we have seen more tariff headlines. I know the bulk of your business, is you do production in the countries where then you are selling into. But is there any sort of cross-border tariff exposure that you have?
Yes, you were exactly right. So more than 50% of our sales are in U.S., which is mostly local. U.S. exports around 15% of their revenues. And then the other regions of the world, because of this, our global footprint, and that's the idea of this geographic diversification, is that we can rearrange trade flows to offset this impact. We always have an impact, but looking globally to JBS will not be relevant because, again, this rearrangement of trade flows. Basically, we can export more from Australia, we can export less from US, and then offsetting and balancing this to minimize the impact.
I'm also curious about the Brazil business, just domestically there, because of the tariff impact on the local economy. Do you expect any kind of effect on beef consumption in Brazil as a result?
No, first, in Brazil, we've been developing different markets in the last years. So besides China, which is our the main destination for the Brazil beef, we also opened up markets like Indonesia, Vietnam, Philippines. So this is also helping to offset in terms of the business for Brazil. And in the consumption of Brazil, the domestic consumption in Brazil continues to be good because of basically GDP growth has been exceeding expectations. So the domestic demand, it's always good. So the impact could be one or other facility that could be destined to U.S. export, but as a whole, we also have been seeing a good demand for beef. In fact, even in U.S. globally, protein consumption continues to be very good, and also beef, despite of the price.
And you all are investing not just in raw protein, but also in processed products, right? I know you're investing $100 million in a pork facility as well in the United States. When should investors start to see more of a contribution from all of that in your earnings?
Yeah, the greenfield takes longer. For example, we invested in the recent years in Italian meat plants, in bacon plants, that today, for example, we used to sell all of our pork bellies to third parties. Now we process half of our pork bellies, but greenfields takes longer. Like take maybe considering the building, the ramp up, the marketing time, like say 2 years to be still starting impact on the earnings. And if you have an M&A opportunity, this could fasten this process. But again, M&A has to be for the right price. If you don't have an acquisition opportunity for the right price, we'll continue to doing these greenfields, increasing our downstreaming our production, increasing our value added and brand segment.
Finally, I wanted to ask you a question about U.S. politics, because Pilgrim's Pride, your subsidiary, gave $5 million to the Trump inauguration. Many companies here in the U.S., of course, contributed to that. But I believe that was the largest single donation. Have you gotten access to the Trump White House? Have you found them to be receptive to any kind of input you have on things like tariffs or other types of priorities?
Now, PPC is an independent company, and as far as I'm concerned, it has always been participating in the democratic process of the U.S., and that's all I know. That's all. I don't have anything different from that side.
Fair enough. Guilherme, it's good to see you. Thanks so much for taking time to join us today.
Thank you, Julie.
Thanks.
Bye.
The crypto rally hit a stumbling block this morning after that hotter than expected wholesale inflation print. Bitcoin off the fresh record high it hit earlier this morning. Ethereum regaining some momentum, and we've seen Ethereum looking to march towards its first all-time high since 2021. For more on the outlook for the crypto market, we've got a panel of experts. Brady Dale, Axios crypto reporter, and Noel Atchison, the author of the newsletter Crypto is Macro Now. Thank you both for being here. Brady, I want to talk about, yes, Bitcoin's getting to a new record high, but Ethereum has been stealing the thunder as of late. Can you tell me a little bit about what has been behind this latest push? Because it hadn't been keeping pace, and then it kind of hit the gas.
There's a lot of good things going for Ethereum. You know, it's gotten a lot of good upgrades this year that people are really happy about, that accrue more value to the chain. But I think probably the most important force has been this digital asset treasury company trend. So, you know, as your viewers probably know, there's been a bunch of publicly traded companies that have been going out there and buying a ton of cryptocurrency, all kinds of cryptocurrency. And it took a while for that to get started with Ethereum, but now it's going crazy. The two in particular ones are SharpLink Gaming and Bitmine Immersion Technologies, but there's others too. And yeah, they're buying so much ETH that it's taking supply off the market, just as investors seem to start to be wrapping their head around the cryptocurrency. And so, you know, more demand, less supply, price goes up.
That is how it works, isn't it? Noel, what about you? What are you hearing within the crypto industry about Ethereum's latest move and also this latest wave of that treasury adoption?
Argue that the regulatory play is as important because the run started really when it looked like the Genius Act was going to get passed. And why? Because stablecoins still to this day largely move on Ethereum. And so Ethereum is going to be much better positioned to benefit from any increased stablecoin adoption than would say Bitcoin. And then, of course, we have the progress of the Clarity Act through Congress, and that is going to benefit the Ethereum community much more than the Bitcoin community. And so I think what really happened here is we saw this regulatory thaw, and we saw investors look around and ask themselves, why has ETH so underperformed Bitcoin so far this year? Maybe there's a catch-up coming. They started piling in, the treasury narratives kicked in, as Brady said, and then momentum did its thing.
Brady, you had a description of Ethereum that I found helpful in one of your latest pieces. You said Ethereum is basically a giant tech company, except it doesn't have a CEO office or a board. And in that way, it's quite different from Bitcoin. But what do you mean by that? For people who aren't as familiar with the sort of nuances between cryptocurrencies, can you give a little more detail on how Ethereum is different?
Sure, yeah. I mean, you know, Bitcoin came along to reinvent money, and that's what it is, and that's pretty much all it is, which, and I'm not minimizing it, that's a very big thing. But Ethereum can do a ton more. So people can come to this platform with all kinds of ideas. They can invent, you know, new versions of money markets. They can invent new entertainment companies. And so all of these people are coming together and working out the best way to use this substrate. And so that makes it function a lot more like, you know, some kind of combination of like Stripe and Yahoo and Twitter and all of those things all in once. They're figuring out what it's best for kind of collectively. And so it's creating services for people, you know, right there on the blockchain. And folks are starting to realize that a lot of value accrues to that. And so, yeah, it's a different value proposition out there on the internet than Bitcoin is. And I think investors are starting to wrap their head around how different it is and why it might make sense to allocate a little bit to it.
So we're seeing those Ethereum prices press toward a record. The folks over at Fundstrat, Tom Lee's shop, have been very bulled up on cryptocurrencies broadly for a long time. Their latest target for Ethereum is 15,000 by the end of the year. Noel, is that a realistic number, or is this just like another one of these numbers that people like to throw out there?
It's probably a number that people like there because how do you value something like Ethereum? How do you put a figure on it, especially when it is entirely driven by sentiment? Right now, sentiment is very positive. We all know that can change. I'm not saying Tom is wrong, hopefully, but it's intangible products. It's a worldwide network. It is a new technology, and as human beings, we're traditionally very bad at knowing what new technologies are going to be used for. However, Ethereum, Brady is right. Ethereum is different from other new technologies, different from other tech companies even, in that anyone anywhere can get in early. Anyone anywhere has an access to a token that will give them upside if indeed the new technology does kick off. And it's a global asset and a global network. I think that's a very overlooked feature in predicting prices of ETH going forward.
And Brady, do folks in the industry expect that Bitcoin and Ethereum will start to converge once again, or is the relationship more permanently sort of disconnected?
I guess, we'll have to see. What has been interesting to me is for the last two cycles, 2017, 2018, and then 2021, they moved a lot more closely together. So in 2017, Bitcoin peaked in December, Ethereum peaked in January, it's about a month off. And then in 2018 and 2021, it happened like virtually at the same time, a few days apart. This time, as your viewers probably know, Bitcoin has been setting new all-time high after new all-time high since early last year, and Ethereum still hasn't matched its 2021 records. And so it has already diverged pretty seriously, but now they're starting to move more in tandem again. Maybe that continues, but like I said, these are different products in the world. And now that lots of institutional investors have wrapped their head around Bitcoin and are starting to wrap their head around Ethereum, we could see them start to diverge, behave differently, respond to different forces in the world.
And speaking of sort of the changing forces of what's affecting cryptocurrencies broadly, the institutional adoption that the industry has called for some time is here, right? We're starting to really see it more. We saw the executive order on crypto being allowed to be in 401ks. So as we all know, crypto tends to move, or maybe not everybody knows, but crypto tends to move in 4-year cycles, right? And you get these crypto winters. Noelle, now that we have reached this sort of tipping point maybe of that adoption, do crypto winters still happen? Does that cycle still happen?
If you're going by the traditional definition of crypto winter, when interest just exits the ecosystem, it's not just about low prices, it's about pretty much zero development activity as well, then yes, I don't think we're going to get the same type of crypto winter that we used to have. And why? Because the risk profile has changed. Before, when there's no possibility of material gain, there's no point in putting your neck on the line in developing applications for networks that you don't even know are going to be declared legal. Now that risk is off the table. Now there's little risk other than upside and downside of token prices to continue to develop. So while we may have bear markets in crypto prices, that doesn't necessarily translate into a winter when the developers also leave.
Really helpful precision there between winter and a bear market. Brady, Noelle, really appreciate it. Thank you.
Thank you.
Coming up, Peloton preparing its biggest overhaul in years. We'll tell you everything we know after the break. Don't go anywhere.
Welcome back to Yahoo Finance. I'm Ali Canal, live at the NASDAQ. Let's get a quick check on the market action about 2 hours into the trading day. And we did see the S&P try to inch its way into the green earlier in the session, but we gave up those gains and we are currently down about 0.1%. Similar story with the NASDAQ. And then the Dow is off, let's say, roughly 110 points here. And this comes after we had that hotter than expected CPI print. But what really caught my eye was the equal weighted index. This is down more significantly than the composite S&P 500, down around 0.9%. And this is telling us that the average stock is taking a bigger hit than the headline index shows. So this is a sign that weakness is maybe broad-based, with earlier support from the mega caps now fading a bit. And that's something to keep in mind as we continue to monitor the health of this rally, the sustainability of it. And if we take a look at Fed Fund futures, we are now below 90% when it comes to a September rate cut. We had been hovering at around 95% in the immediate aftermath of that PPI print. So maybe a little less conviction that we could see that rate cut in September, although I would argue that 88% is still pretty darn good. We're seeing that reaction play out just a bit in the bond market. So 10-year yield up around 3 basis points. We are still below 4.3%. The 30-year yield up roughly 2 basis points. Again, still below 4.9%. And even though we saw some pops in long-term yields earlier in the spring, by and large, yields have pretty much traded sideways since the start of the year. And there's a lot of calmness, I guess you could say, in the bond market right now, despite some of these greater inflation jitters. But keep it right here on Yahoo Finance. We'll be tracking all the market moves throughout the session.
Now time for some of today's trending tickers. We are watching Paramount, Peloton, Ulta, and Target. First up, Paramount seeing volatility after closing 36% higher in yesterday's trading session. Shares are falling today. For more on those dramatic swings, let's bring Allie Canal back in. So down 7% right now, Allie. The merger just got completed a few days ago, and this stock has been swinging like crazy ever since.
Swinging like crazy, and like you said, less than a week after these two companies tied the knot. And we did get the news earlier this week that CEO David Ellison, he came out swinging with that UFC deal. That's a 7-year deal, $7.7 billion. And that makes Paramount Skydance the exclusive U.S. home for all of those UFC events. Now, Raymond James said that the merger is leaving the company with a stronger balance sheet, and that this UFC deal could help improve on that churn, even though it is a bit expensive. But not everyone is sold. Evercore ISI, Kutkin Morale, he came out with a note earlier this morning, the analyst saying that this week's price action reminds him of the 2021 short squeeze in legacy media. So we did see that big run up in shares followed by a sharp drop. He points out that the rally has come without much fundamental news, and he expected shares to pretty much remain flat until we got that next financial update. Clearly, that hasn't happened at this point. Now, I did go out to Vandatrack Research to get a sense of how retail traders are looking at this name. And retail traders put more than $7 million into the stock over the last 3 days alone. That marks a pretty sharp turnaround from last Friday's outflows, where we saw nearly $600,000 leave the name. So the question, lingers. Is this a meme stock? Is this a fundamental story? We're just going to have to wait and see.
Yes, we will. And next up, let's talk about Peloton. It is gearing up for an overhaul. Bloomberg is reporting that it is planning its biggest product upgrades in years, including refreshed hardware, new accessories, AI, and more. The company did not respond to Bloomberg's request for comment here. The shares are actually trading a little bit lower, and they recently cut their forecast here, Allie. So, we'll see what this kind of refresh looks like and whether it works. I think the shares are down about 1% this year.
Yeah, and the goal here is more personalized workouts, greater engagement, more hardware, subscription sales. It's all happening less than a year into CEO Peter Stern's tenure. Now, he is a former Apple exec, which is a bit ironic because Apple has been under pressure for really being behind a lot of that AI push. But he is trying to make Peloton more of an AI-focused health company, a wellness company. Of course, the stakes are high. We did see hardware revenue drop nearly 18% last year. And then just last week, like you were saying, Julie, the company issued that weak forecast and announced another round of job cuts. Shares are down this afternoon, but one of those pandemic darlings that has just really struggled. I will say year over year, we are up around 200%. But if you take a look over the long term, over the past 5 years or so, we are down about 100%. So it's just been a name that struggled to really gain post-pandemic.
And finally, let's talk about Target and Ulta. They're announcing they're going to end their partnership. Ulta has 600 beauty stores inside of Target. And now Target says it is going to be ending that, I believe, as of next August. And it's going to just pursue its beauty strategy on its own, Allie.
Right. So this is the store within the store concept. Right. It was very popular. The news is hitting both stocks. Target is down around 2%. Ulta also off the same here, around 1% now in afternoon trading. Now, beauty has been one of the few bright spots for Target. It's been struggling with softer sales. We've seen weaker traffic. There's that lingering impact of some of those boycotts from last year. And the retailer does report earnings next week. So we will get a better sense of how the fundamentals are for this company. But Target is saying that it's looking to take its beauty business into a next phase of growth, more focused on trend forward curation and wellness. Ulta, meanwhile, saying that the partnership did help expand its reach, but that it had already paused operating new locations inside Target as it works to improve some of those efficiencies. And overall, I will just say the beauty industry is really tough to chase. There are constantly new trends emerging, so you really have to be on the pulse of things. And we have seen a lot more beauty influencers and celebrities come out with their own lines, and they're going direct to consumer. So there is a bit of some tension there when it comes to how beauty can really help a lot of these mainstay brick and mortar locations, but something that I'm sure we'll be hearing more of from Target on that earnings call.
Yeah, definitely. Looking forward to that. Thanks, Allie. And you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Coming up, is buying the dip the best way to time the market? Jared Blickery explains in today's Stocks in Translation. Stay tuned. You're watching Market Catalysts.
Stocks are on a tear once again. The S&P 500 just notched its 17th record closing high of 2025, and it seemed like a good time to answer a very basic question in today's Stocks in Translation. Which is a better investment strategy, buying the rip or buying the dip? So first of all, I started off by creating a chart here. I went all the way back to 1960 to get over 60 years of market history in the S&P 500, and I ran a study to see what the stats were if you were to buy every single all-time high in the S&P 500, all 1,100 of them, and then I compared that to buying every new one-year low or 52-week low, all 500 of them. Then finally, to have a baseline, I measured the results of buying every single day, all 16,000 of them plus, and guess what? For returns or performance, first of all, this is what we're showing in this chart. It is the median, which is very similar to an average, but you don't have it as exposed to outliers as much. So first of all, what if you were to buy every new high and hold for 1 week, 1 month, 1 quarter, 6 months, 1 year? That's what we're seeing in white. And so for some of the lower time frames, there's really not a lot of juice to be gained out of those. You can actually see that buying new lows was a slightly better strategy for 1 month out, but when you get to 1 quarter here and 6 months out, it's not a very good strategy at all. In fact, you want to be buying the highs if you're just an intermediate term holder there. Once you get to 1 year, the results improve dramatically. Just in terms of median returns, we're looking at about 10% plus, and you can see actually that buying new lows produces slightly better results. Now, the actual returns and what we're looking at here in median returns is not the only metric you want to consider. You also want to consider the hit rate, the win rate, or percent positive. And that's what I'm presenting here. So this scale goes from 40 to 80%. Nothing even approaches 100% or goes below 40. So at 1 week, 1 month, we're seeing pretty break-even results there, or neck and neck results, I should say. Then at 1 quarter and 6 months, these are the two time frames where buying the new lows, buying the dips wasn't the greatest strategy. Those have pretty bad percent positive statistics there. But then once again, once you get to the 1 year mark, you have pretty similar results between buying the new highs and buying the new lows. And compared to the baseline, there's not much of a difference between them. So I decided to go back to the drawing board, and I actually extended the study to include not only 1 year, but 2 years and 3 years out. So this is looking at the median returns again. How much are you going to see in your account? Now, 1 year, we already saw those results, but I left them in there so you can compare to what happens to 2 and 3 years. What's interesting is that buying new lows is a much better strategy in terms of returns once you go 2 years out and also 3 years out. Although buying the highs kind of comes a little bit closer to those buying the new lows once you go 3 years out. And it's neck and neck with that benchmark, which is buying every single day. Now, if we take a look at percent positive, we can see the results don't vary that much over the long term. So for 1 year, we're looking at percent positive of about 75% here. 2 years out, everything's neck and neck. That approaches 80. And then at 3 years out, we're a bit above 80%. What I didn't show here was the volatility. And if you take a look at the volatility that we experience in some of these studies over the short term, let's say 1 week up to 1 year, you have a lot more volatility if you're buying the dips. And that's not surprising. Bull markets are boring. And so when you're buying the highs, you're not experiencing a lot of volatility on those results. But when you're buying the lows, it's easier to get shaken out. So if you don't have a stomach for that, all that volatility, you might not want to be buying all those lows. But to conclude, I found some interesting things in here. Buying the dip tends to deliver the best returns overall. And then if you go up to 2 years out, buying new highs, that wins more. That's that percent positive that we were talking about. And then in the short term, buying the dip can be a bit bumpy, and that speaks as to the volatility I was just speaking about. And finally, the best strategy for holding long term, that's 3 years and out, buying the dip is the best. And so to expand the study, we could go a few more years out and we could measure some other characteristics, but I think it's a little bit not intuitive that buying the highs is not always the best strategy, because that's something that's repeated a lot in the press here. Bottom line, tune into the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts. Stay tuned for more market catalysts.
Shares of Tapestry plunging after the company issued a weaker than expected annual profit forecast. It's dealing with higher tariff costs. The maker of Coach and Kate Spade now expects a $160 million hit from U.S. import duties this year. Joining me now is Dana Telsey, Telsey Advisory Group CEO and Chief Research Officer. Dana, it's good to see you. This new tariff forecast from the company really seemed to catch investors off guard. Do you think that Tapestry did not do a good enough job sort of signaling that this was coming? Oh, Dana, I can't hear you.
Hi, can you hear me okay?
Yes.
Oh, good, thank you. Thank you so much for having me. I think there's a couple things to add to the tapestry of what's happening. I think overall the strength of the Coach brand continues, up nearly mid-teens. The Kate Spade brand weaker than expected. And similar to what we heard from Ralph Lauren last week, the uncertainty regarding the back half of the year in terms of the elasticity of consumer demand is there, and these tariff headwinds are real. When the tariff rate is changing on almost a regular basis, it's hard to basically manage what the impact is. But to build a competitive moat with durable growth is what you need. And that's what they're doing with the Coach brand right now. And let's also keep in mind, when you look at first half, back half, is there some conservatism that's built in because the strength of the top line with the AUR growth, with lower promotions, and with new product innovation, will that help to offset some of these tariff headwinds as we go forward into the back half of the calendar year?
Dana, what is the pricing power situation for Coach and Kate Spade? And is it stronger at the stronger brand, and therefore maybe it can pass on some of those costs, but not all of the tariff costs?
When you think of the two brands, Coach is around 85% of the business. The Kate Spade brand is around 15% of the business. They're investing in marketing in the Kate Spade brand in order to use the playbook of Coach and apply it to Kate to see if that takes hold. With the Coach brand, the families of handbags that they have, whether it's the Tabby or the Brooklyn or the new Kisslock, they keep adding other bags in that and maintaining the exclusivity that they don't overproduce. That's why they're able to deliver full price sales of innovative product for the Coach business. Kate is a work in progress.
What do they still need to do with Kate, and are you confident they're going to do it?
I think they're continuing to reduce the number of SKUs. They need to be able to have a brand that has resonance and that a brand has to say what it does and do what it says. And I think they're formulating what the brand meaning is, and I think that's first to come. An investor day is coming up for Tapestry on September 10th, and I think an update to the 3-year algorithms that are first to come will be put in place.
So you're still positive on Tapestry. I want to turn to another company that reported today that I also thought was interesting, and that is Birkenstock. Now, here's a company that pretty much makes everything in Germany, right, and then exports it to the U.S., so it is subject to those EU tariffs. How do you think it is navigating? Because it does seem to also have some pricing power there.
It does. And when you think about a couple things that are happening there, number one, they are not over distributed. They produce everything overseas. They're bringing it here to the US. They've been able to take price. Their month of July is accelerating into the month of August. The newness around closed-toed shoes, which is a higher average selling price, the brand fans of Birkenstock are capturing some of these new items, and closed-toed shoes are higher priced than sandals, and they're bringing in new customers. Let's not also forget that they don't have a lot of their own stores in the US, so there continues to be expansion distribution that's going on. I think there's fewer strong brands. Birkenstock is one of them. That's why they can sell the goods at full price, but tariff headwinds are not to be ignored, and I think that's why they maintain the guidance even though they beat on the bottom line.
Well, and that does seem to be disappointing investors here. We're seeing those shares pull back a little bit, but do you think this is an opportunity for people to get in? In other words, why wouldn't you be more concerned about that guidance hold?
I think overall there's potential upside to that guidance. They don't have enough goods to be able to meet the demand. They do their own manufacturing. They very carefully manage distribution, and their ability to innovate with product, to open more of their own new stores, curate the brand experience, and also open in other regions like in Asia, like in Europe. There's global distribution opportunities for them beyond just North America.
Dana, it is always great to get some time with you. There's nobody in retail knows as much as you do about this stuff. It's great to talk to you. Thank you.
Thank you for having me.
That's it for Market Catalyst. I'm Julie Hyman. Thanks for watching. More Yahoo Finance coming up.